Hi, my name is George Dagnino, and I am going to talk about capital flows, business cycles, and their impact to current market trends. I'm going to focus on two main periods, the period going from 14 to 16, where the market did not do much, and the period 18 to the current times. Of course, we had the blue line, which is a moving average, trending up. Now it's sort of flattening, but the market is well above this trend line and suggesting that the trend is clearly up. No question about that. This is an important chart because it shows the capital flows in and out of the stock market. Capital flew into the market 12-14, and of course the market went up. Capital flew out of the market, and the market went down from 14 to 16. Went back into the market from 16 to 18, and from 18 on, capital exited the stock market, and of course the market has not done much since early 2018. Try to remember these dates because I'm going to refer to later on in the presentation. This is a chart that we compute from internal data, from advanced declines, relationship between sectors and the economy. Anyway, is a real-time indicator that gives an idea what the business cycle is doing. This is what we found. In fact, if you remember the dates I said before, from 12-14, the trend is up. 14 to 16, the trend is down. 16 to 18, the trend is up. And from 16 to 19, the trend is down. What I think is simply amazing is that this graph, which is computed from technical internal data of the market, it corresponds exactly to the same turning points of capital flows. So what this indicator is saying that capital flew from 16 to 18 and confirms that, and the market went up. But since 2018, our real-time business cycle indicators reflects a capital flow out of the stock market, and the stock market has not done much. Right now, this indicator, as of just a few days ago, is still heading lower. So it points to an economic slowdown. What I want to focus now on is what happened during the period 2018 to the current 2019 in June to various stock sectors. Again, remember from the previous two slides, capital flew out of the market, and then our business cycle indicator says that the economy is in a slowdown phase. What we see in this chart and the following chart is the relative strength of sectors of the economy relative to the S&P 500. So stable as the economy slowed down, they were stronger than the stock market because they were behaving much better than the stock market, and the trend is in fact is up. This is another sector, the utility sectors, and again, this is from 18 to current a few days ago. And you can see the utilities during the period of slowdown in the economy where capital flew out of the market, the utility sectors was much stronger than the market because the relative strength was in an uptrend. Same period, 2018 to a few days ago. Again, the capital flew out of the stock market. Our business cycle indicator says the economy is slowing down, and a strong sector has been the real estate sectors. In fact, its performance is rising relative to the stock market. So it's been a very strong sectors in a weakening economy like the two other sectors. This chart shows treasury bond yields, long-term treasury bond yields. And as you can see, when the economy slows down from 2018 to the current period, yields decline. So yields decline when the economy is weakening. Now, why is that important? Because the bond market, bonds, when yields decline, bond prices rise and offer tremendous profit opportunities. I have several videos that shows why this is the case. So from 2018 to 2018, yields decline in the bond market has been strong. And as long as the economy is weakening, yields will continue to decline and the bond market will remain strong, offering an interesting investment opportunity. But while some sectors offer great investment opportunities, other sectors, though, should be avoided during a period of slow economic slowdown like from 2018 to the current times. One of these sectors is the energy, XLE. The trend of this sector is down because it shows its relative performance to the market has been very, very disappointing. This is not one of those sectors that one should invest if one expects the economy to be weakening. The metals and mining sector, XME, is the same as the energy sectors. As you can see, has been very weak relative to the stock market during the period when the economy slowed down. And by the way, the metals and mining, I include in that also gold. So when the economy slows down and is in a disinflationary mode, metals and mining stocks are not attractive. Small cap stocks are part of also those sectors that do not do well when the economy slows down, as it did from 2018 to current 2019. The relative performance of small cap sectors has been very disappointing relative to the stock market. And again, it's another area that investor, I think, should weaken if they see the economy slowing down. I've been showing this chart many times in my tweets, and it shows the performance of the 11 sectors of the S&P 500 in the last 200 days. And in the current 200 days, what are the strongest sectors with the economy weakening? You guessed it. There are staples, utilities, and real estate. And of course, bonds. They're not shown, but they have been quite strong since the beginning of the year. In fact, they are outperforming gold for that matter. So let me recap this presentation. Our real-time business cycle indicator reflects capital financial flows in and out of equities. And a decline in our business cycle indicator shows that capital is flowing out of the equity market and suggests that the best investment strategy is to avoid cyclical sectors and emphasize utilities, staples, and real estate and bonds. This information is analyzed in detail in each issue of the Peter Duck Portfolios, and of course is discussed in great detail in my 3 books, Profiting in Bull or Bear Market, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think. Again, thank you very much for listening, and I'll see you really soon.